Welcome to QLTS School's video series on the SQE1 assessment. Today we'll look at a sample multiple choice question on corporation tax.
A company purchased an investment property 3 years ago. The purchase price was £100,000. The company sold the property last year for £150,000, deferring payment of corporation tax on the chargeable gain. At the same time, the company purchased a further investment property for £200,000. In the current financial year, the company has agreed to sell the further investment property for £300,000. What is the value of the chargeable gain on which the company will be liable to pay corporation tax? A. £200,000, B. £150,000, C. £100,000, D. £50,000, E. The value of the chargeable gain is nil. The best answer is B. The value of the chargeable gain is £150,000. Capital gains tax is not charged on capital gains made by a company, the Corporation Tax Act 2009, Section 4. Rather, a capital gain is treated as a profit or chargeable gain for the purposes of calculating the corporation tax liability of the company and calculated in accordance with Part 3 of the 2009 Act. If a company sells an asset on which it makes a capital gain, but replaces that asset within 3 years, the company may choose to postpone payment of corporation tax on the chargeable gain until the sale of the replacement asset. This is known as business asset rollover relief and operates in practical terms by treating the purchase price of the replacement asset as having been reduced by the amount of the deferred gain, so as to increase any gain made on the sale of the replacement asset. See the Taxation of Chargeable Gains Act 1992, Sections 152 to 160. Having purchased the first investment property for £100,000, the company sold the property for £150,000, a gain of £50,000. As the company deferred payment of corporation tax on the chargeable gain, the purchase price of the second investment property will be treated as having been £150,000, i.e. the actual purchase price of £200,000 less the previous chargeable gain of £50,000. The company intends to sell the second investment property for £300,000, a gain of £150,000 as against the revised purchase price. It follows that B is the best answer.